Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: from Stuff on the 25th of October, bank stores are the widest they've been in a long time. Second topic, from landlords.co.nz on the 24th of October, BTR on cusp of becoming a major housing sector. Third topic, interest.co.nz on the 23rd of October, rents for apartments in Auckland CBD have recovered from their lockdown lows. Fourth topic, from CoreLogic, 25th of October, mums and dads set for a comeback. And fifth topic for this week in review, from One Roof on the 25th of October, Tony Alexander, investors are feeling a lot happier. Should first home buyers be worried? So first up for this week in review, from Stuff on the 25th of October, bank stores are the widest they've been in a long time. If you intend to buy your first home in the near future, you may be aiming to save a sizable 20% down payment. However, given the national median price for first-time home buyers in September, which was $650,000 across the country, it's a substantial sum to save. The good news, according to mortgage brokers or mortgage advisors, is that many banks are now willing to work with borrowers who've got less than 20% deposit. Loan-to-value restrictions permit them to provide 15% of new owner-occupier loans to individuals in this situation. Furthermore, there are exceptions, particularly for newly constructed homes. Jeremy Andrews, a mortgage broker from Key Mortgages, noted that major banks currently offer more options to first-time home buyers with strong incomes and at least a 10% deposit compared to earlier this year. The Reserve Bank's data reveals that lending to individuals with deposits smaller than 20% increased to $673 million in August, up from $439 million the previous year, but down from $761 million in 2021. Glenn McLeod of Edge Mortgages pointed out that most banks are open to considering loans with smaller deposits if a sale and purchase agreement for a property is in place. However, each lender has its own policy regarding monthly income minimums, making the serviceability test more challenging. For those who can balance the requirement of sufficient income to support a larger mortgage and higher interest rates, but not so much that they disqualify for government-backed first home loan, this is a viable option. The scheme permits individuals or couples, including single parents, with incomes up to $150,000 or individuals with incomes up to $95,000 to have a 5% deposit. If you don't have a 20% deposit, you can anticipate paying standard interest rates at the banks, which currently range from 7.45% up to 7.85% for a 1-year fixed rate, in addition to a low equity fee or margin. Recent data indicates that first-time home buyers have been quite active in the market, responsible for 29% of purchases in Auckland and Christchurch. CoreLogic's chief property economist, Calvin Davidson, attributed this to favourable market conditions, including increased bank lending to those with smaller deposits. Meanwhile, people moving from one property to another and investors with mortgages were less active, accounting for 26% and 21% of purchases in the third quarter of this year, respectively. If you're looking for a good mortgage advisor, we recommend MITeam, which is MITeam for mortgages and insurance. So feel free to get in touch with them by emailing office@miteam.co.nz and they'll be happy to help you out. Second topic for this week in review, from landlords.co.nz on the 24th of October, BTR on cusp of becoming a major housing sector. National's plans to support the build-to-rent sector, or the BTR sector, as a new asset class are eagerly anticipated by New Ground Capital, which is a pioneer in this type of rental housing. Chris Bishop, the housing spokesman, has announced that a national-led government intends to make 2 legislative changes to facilitate BTR developments. These changes include amending the Overseas Investment Act to provide institutional investors with greater investment certainty and amending the Income Tax Act to allow BTR developments to qualify for depreciation deductions in the same way that other commercial buildings do, which is interesting because I'm pretty sure that there's at least one party that could be in government that is saying that they're looking at removing the depreciation deductions on commercial buildings. BTR developments are primarily large, multi-unit, high-density residential complexes designed exclusively for renting, offering long-term leases of up to 10 years and allowing tenants to make minor changes and potentially have pets. Bishop asserts that BTR developments are significant in housing markets of countries New Zealand looks up to, but they're currently quite rare in New Zealand. He emphasises the need for equitable treatment under the Overseas Investment Act. Roy Thompson, co-founder and managing director of New Ground Capital, highlights the disincentives created by the Labor government for foreign institutional investors. He believes that National's proposed changes would open up a substantial capital market in New Zealand, offering opportunities for foreign institutional investors who have a track record of patient and stable capital investment in BTR housing. The BTR sector is gaining global attention, with the Asia-Pacific region becoming a prime target for investors. The sector's appeal stems from its defensive characteristics, such as the ability to adjust rental income streams in response to high inflation. Concerns about foreign investors creating subpar buy-to-rent complexes in New Zealand are unfounded, according to Thompson. He argues that professional investors understand the need for creating attractive communities and adhere to strict New Zealand planning regulations. As the BTR sector matures, the focus will shift towards maximising its benefits for communities by increasing rental stock and diversifying supply to tenants. Governments may consider requiring developers to include affordable housing in BTR schemes, but it's likely to be considered on a case-by-case basis to avoid hindering supply. Investor returns in the New Zealand BTR market will depend on the style of rental housing developers provide. Some aim for more affordable housing, while others focus on purely commercial rental models. New Ground Capital and other BTR developers aim to significantly increase the rental housing stock in New Zealand, targeting those who can't afford to own homes or who choose not to. The BTR sector's growth in New Zealand is influenced by various factors, including government policies, housing shortages, and a favourable global investment climate. Globally, the BTR sector has seen substantial growth, particularly in the UK and some European markets. In the UK, BTR supply now accounts for 1.5% of the total rental market, and its proportion is expected to grow as the sector matures. New Ground Capital reports a waiting list for its BTR apartments, underscoring the demand and potential for expansion in this housing market. If you're worried about what impact that would have on the private rental accommodation market, so if you're thinking of becoming a landlord or if you're already a landlord, for example, I personally wouldn't be too concerned about this. I think they're totally different beasts. If you're looking at investing in a build to rent, just remember that you're not necessarily purchasing the property, you're purchasing shares in the company. So you're investing in the company rather than investing in the property. So in my opinion, I think property investment as individuals is absolutely still going to continue to be the best way to increase your wealth over the long term. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an investor and a financial advisor, available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. And if you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Third topic from interest.co.nz on the 23rd of October, rents for apartments in Auckland CBD have recovered from their lockdown lows. Residential rents in Auckland's Central Business District, the CBD, seem to have stabilised after experiencing fluctuations earlier this year. Auckland's CBD primarily features smaller apartments, which have been popular among international students and are predominantly owned by investors. During the COVID lockdown, rental prices in the CBD dipped due to a decline in international student numbers and increased vacancy rates. Part of the vacancy rates was caused by the reduction in the number of tourists coming to New Zealand as well, because a lot of apartments had previously been used for Airbnb. So when an Airbnb market dried up with the borders being closed, those properties all entered into the normal rental market, and that caused a bit of an oversupply in the apartment market in the city. Data sourced from bond records kept by Tenancy Services revealed that prior to the March 2020 lockdown, the average weekly rents for newly occupied one-bedroom apartments ranged from $420 to $450, while two-bedroom apartments averaged between $540 and $593 a week. In the wake of the lockdown, with overseas student arrivals dwindling and many returning to their home countries, average rents for one-bedroom units fell to as low as $365 a week, and two-bedroom apartments reached a bottom of $470 a week. See, it's all about supply and demand, isn't it? According to the Ministry of Business, Innovation and Employment, or MB, the number of individuals in New Zealand on student visas dropped from 84,000 in February 2020, just before the initial COVID lockdown, to a low of 31,000 by the end of the following year. Nevertheless, this year has seen a rapid increase in the number of international students returning, which has driven up rental prices. By the end of September, approximately 55,000 overseas students were in New Zealand, and average CBD rents in Auckland had rebounded to $460 a week for one-bedroom apartments and $593 a week for two-bedroom units, remaining relatively stable around these levels. Also important to note is that net migration is strongly positive at the moment. So we've obviously got a lot of people moving to New Zealand, despite all the New Zealanders leaving the country. But with all these new immigrants, a lot of them do tend to settle in Auckland to start with. And one of the benefits of inner city apartments is that most of them are fully furnished. So it makes it easy for those people to come in and rent those inner city apartments as well, which also helps with increased demand. Fourth topic from CoreLogic on the 25th of October, mums and dads set for a comeback. In the latest Market Pulse report, chief property economist Calvin Davidson examines the evolving behaviour of property investors. Over the last few years, the decline in the share of property purchases made by mortgaged investors has been primarily driven by smaller players, including those who might otherwise have made their first rental property investment. However, as tax rules evolve, particularly with full mortgage interest deductions, the so-called mum and dad buyers are becoming a group worthy of close attention. Mortgaged multiple property owners, or MPOs, including investors, have recently been relatively inactive, accounting for only 21% of property purchases in the third quarter of 2023, compared to the historical average of 25%, according to CoreLogic buyer classification data. Now, I think it's important to point out that the more mortgages you've had that you have at the moment, the harder it is to get lending, because banks are testing your affordability on all of your existing mortgages as well as any new one at test rates of up to 9%, sometimes even a little bit higher than that. So, yeah, it's no surprise that multiple mortgaged property owners are having a bit of a hard time getting lending. It's not necessarily that they've not been interested in buying, it's just they might have not been able to purchase. A closer examination of the data reveals that multiple property owners, or MPO-2, those who own two properties, such as their primary residence and their first investment property, which makes up 78% of all investors in New Zealand, and MPO 3 to 4, or multiple property owners who own their own home as well as two or three rental properties, they've experienced the most significant decrease in their share of property purchases. In contrast, multiple property owners with 10 or more properties have remained relatively stable at 3 to 4%. In essence, mum and dad investors, especially those considering their first or second rental property, have scaled back their activities either by choice, such as opting for term deposits, or, like I said, due to stricter lending criteria regarding minimum deposits and servicing requirements. Interestingly, when compared to their own lows in 2018, the MPO 3 to 4 group has been somewhat weaker. Presently, the feasibility of conventional rental property purchases is challenging, with low gross yields, high mortgage rates, 35% deposit requirements, and the inability to deduct mortgage interest. Why would anyone be interested in investing in property? Because despite all that, it's still the best way to increase your wealth over the long term. And there are ways to increase the rental income and the rental return on properties at the moment. We've got clients that are doing particularly well in the current market as well. The negative gap between yields and mortgage rates, when you're looking at the averages or the medians, has reached its highest level in around 15 years, often necessitating significant cash top ups from other income sources, sometimes ranging from $350 to $400 a week. But that does not mean that all investment properties need topping up by that much. For new build properties, the financial outlook differs due to continued full interest deductibility for 20 years, while refurbishments of older properties reportedly remain profitable for those with necessary expertise. If you're wondering how you can get that necessary expertise, come to one of our free events and I'll let you know. Nevertheless, these options are not universally applicable or preferred. Looking ahead, several changes are anticipated. The political shift towards the centre-right, coupled with modifications to property tax rules, including a shorter bright line test and phased reinstatement of mortgage interest deductibility for landlords, is likely to encourage some investors to expand their portfolios and lower their existing owners' tax bills. Yet it remains uncertain whether this will result in a surge in new property investment purchases, at least in the next year or two, given the persistently low rental yields and prolonged high mortgage rates. However, there's certainly a silver lining for property investors, particularly in terms of rental income growth driven by that migration boom that I mentioned earlier, especially in major urban centres like Auckland. Tight rental vacancy rates suggest the potential for increased income streams. One variable to consider is the potential imposition of caps on debt to income ratios or DTI ratios for mortgage lending by the Reserve Bank in the coming year. However, I suspect that the Reserve Bank is not going to impose debt to income ratios because lending to people with high debt to income ratios has been very minimal as it is. And I don't think that the Reserve Bank's going to need to use that tool unless house prices increase significantly in the near future, which I'm not expecting. This might impact mid-range investors the most, such as the MPO 3 to 4 individuals who've leveraged equity in their primary residence and accumulated significant debts, even if these properties don't necessitate substantial top-ups. In summary, a full-scale resurgence of property investors may not be imminent, but smaller players could start to regain some momentum. They may already possess some savings, equity in their homes, and less exposure to the potential debt-to-income system. However, the combination of persistently low gross rental yields and elevated mortgage rates will remain an obstacle in the foreseeable future for those that are a bit more uninformed about how to create yield in the current rental market. Fifth topic from One Roof on the 25th of October, Tony Alexander. Investors are feeling a lot happier. Should home buyers be worried? Tony Alexander, an economist and property expert, observes that the change in government is positively affecting investor sentiment. He conducts a monthly survey of existing residential property investors in collaboration with Crocker's Property Management. According to his latest survey, which he conducted last week, the election outcome is influencing investor concerns and property investment plans. In this survey, Tony Alexander begins by inquiring about investors' concerns. Since the survey's inception in 2021, shortly after the investor tax rule changes were announced, an average of 16% expressed concern about the loss of interest expense deductibility. But the most recent survey recorded a historic low of 13%. Investors are reacting favourably to the anticipation of restored interest expense deductibility, because at the end of the day, that brings it back to exactly how every other business operates: the ability to deduct the interest on loans that you might have to run your business. And property investing is 100% a business. If you're not treating it like a business, you should learn how to. Regarding investors looking to sell due to the March 2021 tax changes, Tony Alexander notes that the proportion has averaged about 23% since early 2021. However, the latest reading is a record low of 10%, which is down from 20% in September and 32% as recently as June. So this is great news for tenants. With less investors facing the prospect of being forced to sell their rental properties, it means that there's going to be, potentially more investors coming into the market, which is going to provide more choice for tenants and hopefully make it easier for people who need housing to find somewhere to live. Tony Alexander also highlights a significant increase in the percentage of investors planning to sell to purchase a different property. This averages 19%, with a September reading of 18%, but the latest result is a record 28%. This suggests that the expected change in the Bright Line test, reducing it from 10 years to 2 years, is prompting more investors to sell and reinvest. This shift indicates rising real estate turnover and positive news for real estate agents as well. For first-home buyers, the situation could be mixed, as they'll have more options, but also increased competition. My advice to first-home buyers is that you shouldn't be worried about the investors that know what they're doing, because chances are you're going to be prepared to pay a lot more for a property than an investor will who's buying based on the numbers. The investors that you should be worried about are the mum and dad investors who are buying investment properties with emotion, the same way that they bought their home. And so, your biggest competition is going to be from other first-home buyers. Moreover, Tony Alexander points out that the proportion of investors expressing concern about tenant legislation has dropped to an all-time low of 9%, down from 15% in September and an average of 17% since June 2021. This likely reflects the National Party's plans to reintroduce no-cause lease terminations, or in other words, the 90-day notice, where you didn't have to prove the reason that you were wanting to evict a problem tenant. In Tony Alexander's analysis, investors clearly interpret the election outcome as reducing their concerns and offering opportunities to reconfigure their portfolios. However, it's essential to note that his survey covers existing investors, not new ones. When calculating the net purchase intentions, accounting for those looking to buy versus those looking to sell, the average since mid-2021 shows no significant shift, with a net 0% of existing investors expressing an intent to make a purchase. In September, there was a net 8% intent to sell, and the latest reading recorded a net 6%. Tony Alexander suggests that while investors welcome the potential changes introduced by the new government pending coalition negotiations, they're not rushing into the market as significant net buyers at this stage. Nevertheless, he acknowledges that other surveys he's conducted and anecdotal evidence from mortgage brokers and real estate agents indicate that many people are indeed planning to buy property. The timing of these actions is uncertain, and individuals' desires may not align with their banks, as financial options remain somewhat constrained for investors, with banks giving preference to first-home buyers. If there's substantial relaxation of the changes to the Credit Contracts and Consumer Finance Act, which previously caused a credit crunch, Tony Alexander believes that this could lead to increased investment purchasing activity. For now, in Tony Alexander's assessment, the most substantial boost to the already flourishing residential real estate market may come from first-home buyers realising that window of opportunity to purchase with minimal investor competition is closing, potentially quite rapidly. And I would absolutely concur with that. The day after the election, we had a massive spike in people that were registering for our free events to learn how to invest in property. So if you don't want to get left behind, make sure you come along to one of those free events. And if you're already a client of Property Apprentice, I'm sure you're well aware of the fact that this is a really good time to be in the market looking for good deals. Optimism encourages people to make long-term financial commitments, such as buying real estate. When people feel more positive about the economy and their personal financial situations, they're more inclined to invest in property. If you'd like to get a great deal, Join one of our upcoming free events called How to Succeed with Property Investing. We don't sell property, but we are one of the best priced lifetime coaching companies in New Zealand, and we also offer full financial plans with lifetime coaching support. As an experienced property investor and a financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our events. Alternatively, you can book a no obligation phone call or meeting with my husband Paul Roberts through our website, propertyapprentice.co.nz. Look forward to seeing you. Thanks for listening.